Greetings and welcome to another show of Wealth Building Wednesdays. I am your host, Bomani Howze. Today we have a special guest with us, Amachie Ackah. He is the co-president of Cove Capital. Amachie, how you doing?
Doing well, Bomani. How are you?
Good, good, good. Glad to have you on the show.
Pleasure to be here.
I've been talking quite a bit over the last few months with Amachie about the importance of equity infusion in deals and the importance of being institutional ready for lending related to small business, any transactions related to real estate. And so I wanted to dive in and learn a bit about you, Cove Capital, and how you got started. So tell us a bit about yourself.
Well, I'm the co-founder of Cove Capital, which is a real estate private equity firm. We're based in Philadelphia, Pennsylvania, but also have an office where my partner and some team reside in Portland, Maine. I am born and raised Pennsylvanian. I live outside of Philadelphia, and excuse me.
Bless you.
Went to the University of Pennsylvania, and have always made the Philadelphia area and Pennsylvania my home. Mm-hmm. Done real estate all my career. I started after business school and went to Credit Suisse, and then was with a firm called Lower Adler, who's now very actively in the Pittsburgh market. No small part, I think, because of some of the advice and views I've had about how the market was so strong, and I know Dean Adler very well and a lot of his team. And so he and Ron Kaplan and others who I'm associated in Philadelphia have also really thought that the Pittsburgh market has incredible dynamics and tremendous growth opportunities. So I first got to Pittsburgh with the Buccini Poland Group about 5 years ago when we bought the People Center. It's been a great investment for us, and we've been looking to do other investments around the market. Feel very fortunate that we were able to become part of the redevelopment of Lower Hill and be part of the Hill District in general. It is really what we do. That's
a great place to kind of stop, and I want to go back
Sure.
Because for a lot of our viewers, from an educational perspective, people want to know, how did you get started with your very first deal?
Well, there's two ways. That's an interesting question. So I worked in real estate my entire career. So as soon as I graduated from school, I was doing investments for institutional companies on their dime. So I don't think he was interested in that as when I started Cove Capital. But when I started, when I first started doing,
let me stop you, because for a lot of people, that's a starting point. There's this kind of entrepreneurial approach towards getting started. If you would take us into some of those earlier conversations I'm imagining that you perhaps brought deals and then presented it as.
So when I was working, when I graduated from school, it's a very interesting story. I worked for Credit Suisse first Boston's real estate group called the Palladium Group. And my first deal in certain ways is very interesting because I was in associate training there, and then I get a call from my office saying, "Come upstairs." And when I came upstairs, I learned that Credit Suisse and DLJ had just merged, which was one of the largest mergers at the time back in 2000. That also meant there was redundancy in the company on many different levels, including the real estate private equity group. And so, over that summer and fall, I watched. We all had glass walls in the offices, and I was in the cubicle. But I watched the two co-owners of Palladium negotiate with Credit Suisse for a buyout of their company, and certain benefits that they would receive since they had been really the pioneers of real estate at Credit Suisse. So they bought out the company for basically nothing. they were able to secure from Credit Suisse to be the anchor investor in their independent funds. The first, fund that Credit Suisse had to put $150 million in, the second one 100, and the third one 50. So they had a secure source of capital for being an anchor investor, so they could raise funds around. And they also struck a deal to be able to work with the placement agent for Credit Suisse, which back then was run by David Howze, which is a legendary capital raiser. And if people don't know, placement agents are the people who introduce groups like mine to capital. They spend their life building relationships with different institutions like pension funds, foundations, endowments, and that credibility that they've developed from being able to screen the best of the best in the business and people who can reliably get great returns and also produce, more importantly, transparent reporting and will be very responsive to investors. That seal of approval can provide you opportunity to get access to large investors on an international basis. And so I was fortunate because some of my first deals were not only on the real estate transaction side, but I also learned how to build a company. I was in charge of growing up, everything like doing the first email address for it, switching it from, Amachie at CFSB.com to Amachie at PradiumGroup.com.
It was like a real internal startup.
The whole internal startup, spreading ourselves out. I was part of the group that looked for the new space and lease. I hired the new associates, and so instead of being an associate right out of business school, just doing spreadsheet work, I was blessed in a perverse way to be in a position where I learned how the business really worked. I worked tremendously closely with Russ Appel and with David Howze on raising those Pradium funds when I didn't know even the industry that well, but I learned it very quickly. I learned the different types of strategies, who in the institutional investor market. And so I think that was really one of the keys to me being able to go and start my firm later on, because I had this insight.
Right. So you get this skill set. You're learning from the best. What gave you that internal drive and courage to say, I'm going to step out and start out on my own?
So after I was at Credit Suisse / Pradium Group for 3 years, I went to Lubert Adler. And I went to Lubert Adler because when I was at that business school in Philadelphia, Dean Adler I was introduced to him by Peter Lindemann, who was my professor at business school and my mentor. And at the time, Dean had a very small fund, but great promise. People knew that he was going places, and his first fund was.
When you say small fund, just for our viewers, let's get an idea of what you refer to as small fund.
So the fund, he's on a second fund at the time, and that was about $230 million. And so he was watching payroll.
So we have our baseline here. Small fund, 230 million. Okay, go ahead.
And so remember, your fees are from that are 1.5% plus expenses and everything else. So
right.
He had a team, but even at that level on the real estate private equity market, you got to watch expenses. It's not big enough to build out a huge team. And so he promised me that when he went to raise his third fund, he would give me a call. He kept his promise. I got a call one day. I always wanted to be back in Philadelphia. As I said, I was born and raised Pennsylvania, and I loved the state and loved the city of Philadelphia. And so he gave me a call, and this is very interesting that he said to me that, listen, I'm raising this next fund. It's going to be about $900 million. But more importantly, I'm calling you now because Ira Lubert and I believe that you can't just be a finance guy from New York to be an effective investor. You really have to understand what it's like in the field and as a developer. And so he sent me by coincidence to work with Dave Poland of Buccini Poland in their hotel group. Now, at the time, Chris Buccini didn't even know anything about this. This was Dean Adler's idea because they had actually in their first and second fund had some issues with hotel investing. It's a complicated business, and they wanted to really have someone on the team who truly had been, exposed to how it's done correctly. And so I worked with Dave Poland in DC for a year. And then when the fundraise was complete, Dave got a call from Dean Adler, said, it's time to set him up. And next thing I know, I was on a train to Philadelphia, and I was starting at Loubert Adler. When I was at Loubert Adler, we transformed, going from a $900 million fund to, the last fund that I was there for was about 2.5 billion. And so when that happens, you start having to look at transactions differently. And so we started doing corporate buyouts. And those I was lucky enough to be part of when we bought Mervyn's, which is a department store on the West Coast and the Rockies and the Midwest. And it was a brilliant transaction. We understood that there was an arbitrage between what that company was trading for on the public market and what the real estate was worth. And so, the real estate's at 5 cap, which is inverse is a 20 times equity multiple, and the company was trading for around a 9. So that arbitrage alone, that the real estate was worth more than the company. And so we bought the company and were able to parse out the real estate and make a tremendous amount for our investors. But then it started getting more and more complicated.
And what year was that?
That was in 2005.
2005. Okay.
Yeah. But then things started getting more complicated, and we started doing these really complex transactions with certain swaps and strips and all these other things. And I said to Peter Linneman, who's the head economist for Loubert, I was like, I don't know what they're doing. I don't understand it. I understand real estate transactions and real estate fundamentals, but this esoteric derivatives, I don't get it. You're doing CDOs and all this other stuff. And so he said, it makes sense. He talked to Ira and Dean, and they helped, introduce me to some of their investors who are looking for someone doing, smaller real estate transactions based on the fundamentals. And that's what really launched me. I found out, so when I went to them about this was 2006, I found out, by 2008 that I was the only person who didn't understand.
That's what I was going to ask. Yeah, I was. So a lot of people tell their story about 06, 7, and 8 leading into 08. And the same experience you had at that time is kind of what was going around.
Listen, I didn't have any insight. I just didn't understand it. I really thought I was just dumb.
And now you can see it wasn't meant for you to understand, right?
Well,
it was to be a little bit more complex for even your highly experienced. And
it turned out all those crazy derivatives and things took down the entire global economy. But I just thought I didn't understand.
Right.
And so I went back to the fundamentals and was fortunate enough to, what I really think it is that to have a mentor where you could be really straightforward to, because often you're in positions, and I would tell you this, never be embarrassed to ask a question, right? To this day, you've seen me in meetings, like, what's that mean? Like, I don't care if people don't, at least I'd rather know and tell them I don't understand what you're saying than be in a situation, because I learned very early when you say it, I just don't understand what you're saying, and you can't get a good explanation, then the alarm should go off.
Right. So you move in through 08, you survive 08, and you survive the recovery. And is this around the time that you kind of stepped out into starting placo?
Yes. Well, so I took a firm that I built and did a couple of mergers with different companies to build up scale and a balance sheet. And then by 2000, was able to build a good track record and do well by investors. And so by 2012, 2013, I parted ways with the company that I built the institutional platinum for. Was fortunate enough to receive significant compensation for what I'd done because I owned 51% of the company.
Nice.
And that's when Brian Eng, who I
so see, I didn't understand. That's why I'm glad we went into that question. So you were able to kind of gradually build your way into your own outfit, but first starting with an existing structure and then getting a piece of that.
Yeah, so I had basically, as I said before, a combination of my experience at Credit Suisse, where I had the experience, and then my experience at Lubert Adler when I asked the question about, real estate, not understanding some of the fundamentals that they were doing. I was introduced, and there was an interesting structure that Dean and Ira presented to me. They said that the projects I was working on, I was able to take 25% of those if I could raise the money around them. And so this is interesting. They warehoused those for me, and I had a contract, an option agreement to buy 25%. And what I did with that is then I went to secondary groups like Credit Suisse's secondary group and Landmark Partners. And they were able to give me capital because as long as in a fund that I raised, 50% of that fund was identified that they can underwrite as a secondary, they were in a good position. So I bought out my option agreement plus had 50% more to go and do other projects, which I actually did with Buccini Poem. One of the projects we did then was just Justice and Landing in Wilmington, Delaware. So I had an aged portfolio, and then I went and built a portfolio, and that went well, and was able to use that tracker to go and raise another fund under a different group and bring my portfolio with me, and then built. This group had only basically been investing their own money and using like a $15 million facility to buy into small real estate transactions. So I was the person who put together their first institutional real estate fund with pension funds and foundations and endowments as their investors, and they wanted to take over, and I said fine. We were able to come to an agreement to buy me out, and I used that ability to have a balance sheet to go with Brian to start Placo Capital.
Nice. And so, what year was that? Did you start at Placo?
2013.
13.
After so I went through the heart of the financial crisis, and then was able to do tremendous transactions in 2010, 11, 12, to be in a position where some of these projects we had realization in 6 months, and through 2-3 times equity multiples in that time. So that gave me a position to show that I'd created a tremendous amount of value, and therefore my buyout was commensurate.
It was nice.
Yeah.
So then you find your way to Pittsburgh on the other side of Pennsylvania, and you did a deal with Buccini Poland Group by way of Chris Buccini with on the North Shore, correct?
Yeah, but so the People's Energy Center.
Say it again.
The People's Energy Center.
Right. So that's right there on the North Shore. And then in 2018, I believe, Buccini Poland Group gets the development right to start at the development of what we're calling Block G for the First National Bank Financial Center in Pittsburgh's Lower Hill District. Tell us a bit about how you got involved with that project.
Well, as I said before, when I did that first fund, I had done some, pretty large scale urban redevelopments with the Buccini Poland group in
And this is
Wilmington,
mixed
Delaware.
use. This is
Mixed use. So, the Justice and Landing in Wilmington, Delaware. We did some projects in Baltimore. So we had done some investing before that. And then obviously also with conversations with Chris, we had done research on markets that we thought were strong outside of the Philadelphia area and East Coast. And Pittsburgh was was top of the list. And so I actually was the one who found the People's Energy Center transaction through our network and said that the group that connects this best would be Buccini Poland group. And so we brought the transaction to Buccini Poland. So I was very integrated into Buccini Poland's expansion into Pittsburgh. I had worked with them and been the equity investor in urban mixed use, diversified urban development on multiple cities. And so naturally, I was the right company with the right track record with them to make this investment. And that just came together. And it's wonderful that there is also a ability for me to be involved with a project that is so important to a neighborhood that is majority people of color and a diverse and neighborhood that has an amazing history as an African American. So that was just a bonus on top of what I've been doing with Buccini Poland and other groups, but just for this Buccini Poland for over a decade.
Mm-hmm. So, obviously some of the background with this particular project is the history that is not unique, unfortunately. Urban open space of 28 acres that has somewhat of a haunting history of failed urban renewal plans and redlining in its background. And this is an opportunity to right some of those wrongs. Just talk to us a bit about your values and why this matters to you with regard to how you approach maintaining, sound investment fundamentals, but yet making sure that the project is going to be delivered in a way that rights some of the wrongs of the past.
Well, I think that for us the fundamentals are strong for the reasons you discussed. That the Hill District is a terrifically situated neighborhood, which is between the tremendous amount of demand generators. Obviously, right next to the downtown district with its corporate demand generators. Next to the University of Pittsburgh, next to the Oakland district. So you're in a situation where this is great real estate by any measurement whatsoever.
And for those that don't know, Pittsburgh's Lower Hill District, so downtown Philly, which Amachie is very familiar with, is Pennsylvania's largest revenue generator for the state, and then downtown Pittsburgh is the second. And Oakland is the third. In the middle is the Hill District that's nestled right in between. And so I just wanted to kind of give that geographic and economic driver context to the Lower Hill.
So this is for sort of the reasons and dynamics you talked about. This is a disinvested and underinvested area. That has tremendous potential. It also has a great residence core of very entrepreneurial and motivated people who believe in the neighborhood, understand its potential, and want to work very hard to fix the chronic lack of access to capital, to tap into the tremendous demand, unmet demand of the Hill District. And so I think those all come together. I think that the wrong, which you mentioned, is the fact that this has been redlined and people didn't look at this market, because again, if you were being objective, you would say that this is a tremendous location, a great opportunity on both real estate, people, history, culture. And so why wouldn't you invest in the Hill District? And so I think that maybe part of it is being a firm of color. Maybe part of it is, cultural connection. But whatever blinders people have had for the last, 50 plus years, we don't have those. And so we see this as completely an obvious choice for investment. I guess, you might say I'm being modest, but I'm thinking that I'm just doing what a rational business person would do. And I think that there was bias, unfortunately, in what, the market had done for the last 50, 60 years.
Right.
That let us get to this place. So that's the wrong.
Right.
And if we can make a great investment because of other people's lack of awareness and biases, and I'm not being willing to recognize great fundamentals, then I think that's a wrong that we are very willing to fix, and to bring access to capital to an area which has been denied that for no reasons of their own is what we've been trying to do for our entire career at Clay Cove Capital. It's a double bottom line. It's great
Right.
for our investors, but it's also what should be done. And it's not, people talk about risk. It's not risky when the reason that demand has not been met is because of bias on the capital market side. That is their fault, not the Hill District's fault.
Right.
And so this is one of the least risky investments that we've made.
So when you're a part of this tide of new investment capital being brought into areas that have experienced disinvestment, and the Hill's not the only area, inner city area within Pittsburgh that should have been otherwise an attractive site. There are other neighborhoods that have large swaths of land that should have been considered prime for real estate development, commercial mixed-use development. 5 minutes from Pittsburgh's downtown center and cultural center. It's banking headquarters, Fortune 4 and 500 companies headquartered downtown. You see the university corridor meeting some of these nearby downtown areas. It just seems like a perfect opportunity. Now, driving capital into some of these areas, especially when you have different different political winds, so to speak. So opportunity zones have come up over the last, since 18, I guess, from the Trump era and that administration. Locally, the politicals signed on to using this as a vehicle to attract capital. Can you talk to us a bit about some of the pros and cons of opportunity zones and how it might be a good vehicle for attracting capital towards real estate deals?
Well, I think that when there is an incentive for all investors to bring capital to disinvested areas, really this is all it is the federal government providing an incentive to fix a wrong that they did, right? The federal government was the one who, took land all over the country by eminent domain, wiped out families and residents and, and businesses and people's, whole life's work. And all they're doing is saying that we are willing to, if you invest in these areas, say that, you don't have to, pay a tax on your returns because, this is something where we as a federal government have already taken our piece. We've taken our pound of flesh already. And then some, right? This doesn't even correct that wrong.
Right.
And that's all it is. It's simply saying we already did what we did. And, for better or for worse, took from these areas. We don't need to tax investment in these areas because we want the capital to stay in these areas. And for those people who make that investment, hopefully they will reinvest with a higher amount that they've kept themselves to reinvest in the area. So I don't see the negatives of opportunity zones. I think, again, it's one of the, sometimes government does understand the repercussions of its actions, although way too late and often not enough. And all they're saying is that we took more than a pound. We took 10 pounds of flesh. And for us to tax reinvestment in an area that we ourselves made the physical, financial, and political barriers to entry, that would be, it's obscene, right? Right now we're going to invest in this disinvested area. We caused the disinvestment, and someone's going to come in and we're going to invest and we're going to take, huge taxes from that. That doesn't make sense, right? And so, that's part of it. And then with that encourages people to understand these areas and do some of the things that I talked about before, where they'll take a look more closely because they believe that, wow, if the government's willing to give me a tax incentive, there must be something there, both on the benefit to me personally as an investor, but also it's not like, the IRS is they're pretty serious about collecting money. So there's something, you must have done something wrong. They're all of a sudden saying, we're not going to collect money, right? And so I think that gives people who not only want to look at this as a great investment, but also a social impact, great incentives to do the work that has been denied for multiple decades and multiple generations.
So for some of our viewers who are small real estate investors, single family units, maybe on their way to small multi-units, there's been this trend of larger firms being able to come from external markets and pay $15,000, $20,000 per door above market price for a multi-unit, say a 20 unit or a 90 unit. And they're able to out the competitiveness level of smaller investors, even if they're in a group of investors versus these larger institutions. There's just no match for those type of acquisitions. And so what we're seeing is a changing of the tide. This is a big transfer of wealth in the history of the country. What do you say to smaller investors who are looking to scale their businesses in real estate, and they're competing with the big firms that are acquiring these?
Well, you shouldn't be competing with the big firms. I don't compete with the big firms. I mean, this is not just in the Hill District or other disinvested areas. This is everywhere. Blackstone's the biggest owner of single family homes in the country. I'm not going out and trying to buy 50,000 single family homes. They have a competitive advantage of that. I think what you need to do is find.
Well, I'm even referring to single family units.
Yeah, that's what I was talking about.
Yeah, so you're not
going to be able to manage those efficiently as Blackstone. But what you need to do is what we do at Placo Capital. We focus on the middle market, and we look for the type of transactions and strategies that are better for middle market investors. And for that,
so how would you define middle market investors?
So, for us, we're doing investments in the $10 to $25 million equity range. And, these large investors that you talk about, they just can't do those. There's an efficiency of their operations when they have funds that are $10 billion that they need to be able to look at transactions that are, $100 million of equity at a time. But the middle market we look at as a great opportunity because of several reasons. It's more based on real estate fundamentals rather than just global capital markets. Our tenants are generally businesses that are regional or local. And so when they need more space, it's because they're doing well. It's not because there was some merger in Europe that decides how much space that's allocated within a multinational corporation. We think that it's less competitive because there's not as much capital looking for those transactions. We think that those are markets where there's more ability to create value because there are entrepreneurs who are eager to learn best practices and to build up their business rather than dealing in the large scale markets where experts are teaching, or not even trying to teach. Experts are trying to squeeze another penny out of other experts. So I think that we've got to recognize that there's a whole situation where the capital markets. You're right. Scale is winning on one way, but I think that from our business, we've seen that scale is not producing as high a margin as you can produce in the middle market and even the lower market. So focus on strategies that will do best. It's simple. Is that I'm not going to be able to position where I'm going to beat an Olympic athlete at a 100-meter run, but what can I do best? And therefore, it's the same thing in anything you do, and in business and in real estate. What's best suited for our skill set? And I think that in the Hill District, there's lots, and other places, there's lots of entrepreneurs who know the market well. They understand the people and the businesses and the demands that are not being met, and building those type of strategies to meet those demands on a localized level. For them, the benefit will be the exit can be building up a small portfolio that can be bought by these larger companies. I think there's nothing wrong with that. Building up businesses
that's
that
an
can
interesting
be bought.
concept. Mm-hmm.
Yeah.
I remember you and I had a conversation about the exit, and there's this one thought. Oh, okay, I'm going to acquire as many properties as possible to build residual income, and then I'm going to hold it, put it into a trust or something like that for generational wealth. But there's another thought that says, think about who you're going to sell it to, so that you can scale and go to the next level, to be able to level up. In our last question for you, what is your kind of approach to wealth building? I mean, obviously you have your path, but if you're talking to more bootstrapped real estate investors who are doing onesies and twosies and working their way up to duplexes and fourplexes, and then going on to as I mentioned before, a 20 unit or a 90 unit. What are your thoughts about holding or versus selling to be acquired, to have your portfolio bought by larger firms?
Well, I think building the scale is interesting, and the multifamily / residential market is interesting because with Fannie Mae, Freddie Mac, and all of those entities that are quasi-government backed, you're able to get incredibly advantageous interest rates and also leverage points because the government wants housing. Right, this is a country we're under housed still.
Right.
And so I feel that that student graduating from college who wants to get into this market and buys a unit and then goes in and does the work and rents it and then creates some value by having a rental stream that in 3 years you can refinance, and those proceeds from the refinance can be used to buy a second unit, and then you can do the same thing over again in 2 years and buy 4 units, and next thing you know, you're starting to build an exponential portfolio. The exit is for you to decide whether you want to, like you talked about before, continue with income or build a capital event with a large exit. Both are great because you've created wealth. One's monetized and one's in your portfolio. Either way, you've created a lot of value. And so I think that there's, if I had to do it again, I would definitely look into that, because it's a great way to look at the government backing you to build a portfolio because of the liquidity and great terms you get from Fannie and Freddie to be in the residential market, and allowing you to basically, double your portfolio every 2 to 3 years.
Right.
You look at the laws of compounding. You do that for a couple of decades, and well, yeah, I wish I was in that situation.
Yeah. Well, Amachie, as always, I love spending time and talking with you. I appreciate you taking a moment to share your experience and your knowledge.
My pleasure.
With our viewer base. Tell us where we can, or folks can go to learn a little bit more about Clay Cove Capital, and we'll exit here.
Well, I think that the best place to learn about, and this is not about Clay Cove Capital. This is about the Lower Hill Development, and about the partners like Lucchini Poland and F&B who are involved with that. It's I believe it's lowerhilldeveloper.com.
Right. And www.lowerhilldevelopment.com, redevelopment.com.
Redevelopment.com. And then you can learn about, more importantly, institutions like the First Source Center, and some of the tremendous work that you and others are doing to make sure that we can bring the resources, the support, the mentorship, the education to the talented people of the Hill District to build stronger careers, take advantage of opportunities, and really build wealth. And that's important. And I want to thank you for all you're doing, because that's the foundation for neighborhoods and for communities, is people being able to reach their potential, because they have what is taken for granted in majority markets where there is investment. So working to bridge that gap that was wrongly denied people of color, let's just face it, in these markets is extraordinarily important. This is not something that was accidental, as you mentioned before. And so that needs to be corrected. And we are fortunate now that we're in a period of time where we can do even a small part to correct the generational bias and structural lack of access to opportunity. And so I just encourage everyone out there to keep the faith, realize that you can be anyone you want to be. We want to be in a position where we're supporting each other to bring those opportunities for that to happen. And for nothing's going to make me more happy than when I'm old and gray, or I can't get gray because I'm bald, but to see the children of the Hill District have the same opportunities as kids in any market, because that's what should happen. And I think that we are fortunate enough for a lot of things that have awakened us as a country to work towards building those infrastructure and resources to allow for people to build themselves up.
Well, that's our time. Thank you all for joining us for Wealth Building Wednesdays. We will be providing this type of content for first-time and seasoned real estate investors, and for those who are just generally looking to build wealth. And so, again, thank you, Amachie Ackah, for joining us. I'm Bomani Howze, your host for Wealth Building Wednesdays, and we'll see you next time.
Thank you.